And that means we are now live here on our YouTube channel, Tackle Trading's Halftime Report, daily show where we go through the markets one step at a time, top-down analysis style, looking at indexes, commodities, currencies, individual companies in the news, which we've been in earnings season. So we've had quite a few earnings reports here this week. Break down any economic data, pretty much anything that we think is impacting financial markets, have a conversation about it, and analyze it to help you guys better run your daily routines out there as traders. And welcome back to our show. If you're a veteran of the community, hashtag Team Tackle right in the chat as you're coming on in here. And if you are brand new to our channel, welcome out. Always welcoming new people to join our community here at Tackle Trading. Click that subscribe, click the bell, come back and join us on a daily basis. Let's go through the coaches here. Introductions. First off, Matt, how you doing today, sir?
Doing absolutely fantastic, Tim. I'm somewhere in the middle of Northrop's earnings report and Teladoc's earnings report. I'm somewhere in the middle there.
You like the market then?
Yeah. I'm kind of wondering why I'm not up a little higher today. That's what I'm wondering.
Sure.
Yeah.
Tyler, how are you doing today, sir?
Good, Tim. Excited to be here.
Good deal. And Greg?
Fantastic. Thanks for asking, Tim.
You know, a couple things we're going to be doing today. One is we've been doing this the last few Thursdays. We're going to play another edition of the buy one, hold one, dump one. Coach Greg has 3 fundamentally sound stocks. He's going to show us later in the show. We'll break them all down, analyze them. But that will be after we go through market analysis here. First off to go. Let's start with the technical read on the S&P 500 up here at the high. It's going to start obviously on the daily chart. Intraday analysis is going to be important here. At the end of the day, I mean, we're sitting here flat, right? But that doesn't tell the whole story. So Tyler, what are you seeing right now in this chart?
You said it. This does not tell the whole story. I feel like the S&P is masking what's going on beneath the surface. So you look at the S&P and you say, oh, nothing to see here. Yeah, but no. When you look at the rest of the market, there are some short-term concerning signs. For starters, the high was 42.11. We were up more than where we're at right now. So intraday, things don't look as good as what it appears. So when you look at the 5-minute chart, you're going to see that we actually were up a fair bit coming into the cash open. And really, since the market has opened, S&P has been in a downtrend. And so this last not even 30 minutes, this last 3 hours is not really displayed on that daily chart. So little concerning in the short run. We'll talk about why here in a bit. Had some lackluster responses to really good earnings. But I will say that, look, it's tough to get overly pessimistic if all this is ending up being just an unchanged day on the S&P. We're watching support of 4170. I think that's the level. If the S&P could stick above that, maybe this is just noise. You breach that, and then it starts to look a little nastier in the short term.
Matt, in the last 24 hours, we've had some pretty, significant news surrounding the financial markets. We had the Fed statement yesterday and then the press conference to follow. We've had significant companies like Apple Computer and Facebook report their earnings, mostly just coming out and beating. You'll do an earnings roundup later. And then you also had President Biden unveiling a plan for a $1.8 trillion spending package for American families last night that the markets probably would receive pretty well, at least in my estimation. So this response in the cash open at least has us scratching our head here this morning. What's your read? What's your read here?
Yeah, I think it is a little bit of a head scratcher when you see the cash open and the response to the cash open. And before we get into kind of the why of everything and what's really kind of transpiring out there, a little context is important. I mean, we are talking about a market that deemed an all-time high literally on the intraday here today. And so all things
hey, that was 3 hours ago.
I get it. I know I need to overreact on Thursdays, right? I got to overreact, but I am a little concerned though, Tyler. I am. I mean, when you're looking at the bevy of news that has came out in the last 24 hours and you're talking about a GDP number that was 6.4%, which has on the backs of some very, very, very positive economic reports that we've been seeing over the course of the last, few months in the marketplace. The labor market numbers are slowly but surely contracting down. I mean, we're talking in the 500,000 and 600,000 range instead of the 7, 8, 900,000 range we were talking about with initial claims even just say 2-3 months ago. So the economic data is rapidly improving in America, and that's a very positive thing. And the GDP number that came out this morning, 6.4%, is reflective of that positive economic data. And so that was a positive, even though it didn't come in at where we expected it. It's still a very good positive for the economy moving forward. When you look at the central bank from yesterday, and the concern, I guess, if you could call it concern, was, are they going to talk about the hypothetical discussion of when they talk about the hypothetical probability of them ever adjusting interest rate policies pertaining to quantitative easing? And I said it like that because that's how Jay Powell says it. We're not ready to talk about talking about tapering. And anybody that's been around the market for a little bit of time understands that tapering conversation and the importance of that tapering conversation to the market as we went through this in 2013, 14, and 15, as we were doing $85 billion a month and we tapered $10 billion every month until we got down to zero. And the old analogy I'd give people is, you got to realize the market is a drug addict and they're addicted to the drug of money. And the same concept is happening right now. The market is a drug addict. Their drug of choice is money, and the liquidity that the United States government and the central bank has, put into the marketplace over the course of the last year, they're addicted to that money. And so you got to talk about tapering, because what's going to transpire if you just came out and said, for example, yesterday, if you just came out and said, we're done. We're done with $120 billion in QE every single month. Well, the market would throw a temper tantrum. And so the Fed wants to ease that conversation. So yesterday, they're not ready to begin the discussions on when they're going to even have the conversations of when tapering is going to begin. So an extremely dovish central bank from yesterday, which is usually a very good support for the market on the buy side. Biden comes out last night, gave a speech at a joint session of Congress, unveils his $1.8 trillion plan, which a large portion, obviously, we're arguing the definition of infrastructure, but we're talking about $1.8 trillion in stimulus that's going to feed the market as a drip feed over the course of the foreseeable future. And then and that is before we even talk about maybe not the response to the numbers, but robust, amazing numbers coming out of Apple, coming out of Facebook. And what did we see? A very muted response today. Not on the overnight action. Overnight action bought it up. Facebook up 8%, Apple up 3%. That's typical responses on these types of movements. But that cash open today, when you had this type of news with this type of technical pattern on a potential breakout, yeah, I do have a question of coming into today, looking at the market and saying, all right, based on all of this, why aren't we up 2% on a breakout towards the highs? I think that is a legitimate question on a day like today. And again, I'm not going to get into the, everything should go up all the time. That's not what we do at Tackle Trading. But when you are sitting on a high base breakout after consolidation, and the market has played defense over the last week and a half, and we've been in wait and see mode for all of this news that came out in the last 24 hours, and the cash open sells it, I do think that tickles the spidey senses a little bit.
Mm-hmm. Yeah, it raises a lot of questions. There's no doubt about it. And now we've got to work through those to try to answer them. Obviously, you had the positive news backdrop. You didn't have the technical response that you were thinking about, and now here we are left with kind of a hesitation day.
And I don't want to play the game, we're just waiting for Amazon. We're not waiting for Amazon at this point. We saw Facebook. We saw Apple. Yeah. We know Amazon's going to come out with the juggernaut. They're going to come out with an extremely impressive number. They're most likely going to... they better be discussing something about that split, because there's too much heat out there. Yeah. There's too much smoke out there on that. So nobody's the market's not waiting on anything at this point. And so at this point, I do think, again, I don't want to overreact to a doji in the marketplace. I just don't want to do that. But again, I think it's okay for those questions to be raised about a little concern on that cash open. That cash open got sold pretty aggressive in the face of some really positive data.
Yeah, and let's take a look at all four indexes, Tyler, because you got similar price action off of the cash open on the NASDAQ, off of the Dow as well, and the Russell 2000. Give me a peek at all four of them. Give me a technical read if you can.
Yeah, I mean, so Facebook, Apple, I mean, you're talking tech there. So the NASDAQ's going to be more sensitive to what those guys did. And you would think, hey, if Apple's killing it, Facebook is killing it, that should buoy the NASDAQ. But it's not. It's not. This has, unlike the S&P, which tried to break out and couldn't hack it, this got smacked at resistance. And so basically tells you, hey, if you were hoping that the catalyst for this breakout over 14,000 is going to be Apple earnings,
it wasn't.
It wasn't. You got to wait a little longer now. It's fine. I mean, the market's, like we said, it's you don't want to overact on the day, but I share Matt's just the quizzical nature of this, where it's like, hey, what's up, man? Come on.
And that, honestly, Tyler, that's all it is, right? It's just, I've been around this a few times. This is a day the market breaks out. This is a day where people are chasing price, and nobody's chasing anything right now. And it's not that they're aggressively selling. Like you said it best in the pre-production show. Where you're like, yeah, but people people just not buying is now the new sell. Yeah. Like things are changing like that. But again, don't want to overreact, but a little bit concerning. But take a look at Apple very quickly as we're talking about it. You know, Apple comes out and they report an absolutely fantastic earnings numbers coming in. The expectation on EPS was about $1. They came in at $1.40. And so 40% beat on EPS numbers, really, really, really good. When you're looking at the raw revenue numbers, 89.6 billion versus the expectation of 77.1. Now, Apple historically we do undervalue what they're going to come out. They set the bar extremely low historically, but still a very good beat on revenue. That revenue beat associated with a 53.6% increase in total revenue year over year. And when you look at the segments of that, you cannot get hotter in iPhone sales. You cannot get hotter in iPad sales. You cannot get hotter in computer sales. iPhone sales year over year exploded, 65% increase. iPad sales, 79% increase. Computer sales, and this is Apple we're talking, guys. We're talking about the juggernaut of Apple, right? And they saw computer sales increase 70%. And even though Tim Cook warned of supply side mechanics and how that might impact Apple moving forward, that's the same concern that a lot of market participants have, is the supply side concerns about chip manufacturers. But even with that said, is there anybody here that doesn't think Apple's going to figure that one out?
No, and a lot of CEOs and a lot of companies are doing that chalk right now. Okay, supply side concerns, chip shortages, all that kind of stuff. We're hearing that like just a drum beat, Matt, over and over and over out of the commentary from these CEOs. So no, I think Apple will figure it out.
Well, and it kind of feels like that's the new, the dollar's too high and it's going to hurt our ability, right? It just kind of feels like this is the excuse that a lot of participants have been saying, hey, just in case. This is the warning. We did warn you. And yet what did Jay Powell say yesterday about the supply side?
He said it's not a big deal.
He said it's not a big deal. And we're going to figure it out.
Yeah.
Right. So he downplayed it fairly aggressively. And yes, it would not be the first time CEOs used an excuse to justify future behavior. And so I'm not saying it's an excuse at this point. They did warn about it. Qualcomm warned about it. Others have warned about it as well. There is a real supply side concern. But again, I do feel Apple's going to figure it out probably a little bit better than other companies will. They just simply have a little bit more of an arsenal to go at this problem. And Tim Cook's expertise is literally in supply chain economics. And so they got the guy that they need to figure this out at the top of the chain over there at Apple. So I'm not concerned about Apple. Is anybody concerned about Apple after these numbers?
Tyler?
Was that $90 billion buyback just for the year, or was that a multi-year time horizon?
It's an increase to their existing buybacks. And so Apple is, I didn't even get into the fundamental stuff yet. Apple also announces $90 billion additional additional share buyback program, and they increased their dividend to 22 cents a share, which represented a 7% increase in dividend. Once again, when you look at Apple from a pure numbers perspective, not the best quarter Apple has ever had. Obviously, we're talking about, the last quarter was the best quarter Apple's ever had, but we're talking about Christmas sales, right? We're talking about that all important holiday season. This quarter, first quarter, man, you got to be very impressed by Apple.
Yeah.
And I am very impressed by Apple, but I'm not impressed by the price performance. And that, once again, is the concern. But you've yet to break a support level yet.
Correct.
And so,
Yep.
like, Tyler, technically speaking on Apple, if you discount the gap up today, you're in the same technical pattern, right? You're in the same type of high base scenario. How is your technical read, or what is your technical read on Apple?
I would probably just ignore, like you said, I would ignore the open. You had a little overnight euphoria. Remember, it's easier to push stocks overnight because there's less liquidity.
Yeah.
I would probably just ignore today's high and just look at the base that brought us into the earnings. We're still in that base. If it can re-break out above 135 and change, I think that's your obvious buy point for as a short-term trader. Otherwise, if it breaks support, then you have to wait and see what the pattern looks like. But for now, you're not really interested unless it takes out that 135.
As of right now, I'm discounting the cash open today, and I'm treating this technically like just from the pattern and the trend perspective. But again, if one day turns into two and we violate a support level, that is a completely different story.
Agreed. Yeah,
100%.
Well,
right,
and in light of the massive buybacks, just real quick, and dividends and stuff, it's like, good, man, give me a 10% drop in Apple. You know where it's going after that, you know?
Does everybody in the market have a standing order, the 200-day moving average on Apple, if it ever gets there again? Like,
you would be a buyer for sure.
Like, everybody's a buyer on Apple. Everybody wants this company.
And it was a good question earlier, Tyler. And the 90 billion, I believe, is just being added to the pool of funds.
It is added to the existing funds. And this is what Apple's like. I have zero problem with Apple doing massive stock buybacks. I have no problem with the company doing increasing dividend, increasing buybacks, reward the investor class. That is a very good thing, a very positive thing. Yep. I have a problem with Delta Airlines doing it when they use other people's cash to do a stock buyback program. I don't like that. Apple, they take it out of their own. They take that 90 billion out of literally petty cash. That's the strength of Apple. It's an amazing thing.
Came out of Tim Cook's pocket, didn't it?
Yeah, Tim Cook
pocket change.
He dumped his pennies.
Yeah.
He dumped his pennies. That's it. Let's move on to Facebook. I'm just going to quickly do an earnings roundup here. And guys, we do have a ton of earnings today. It's not the biggest day of earnings. That is coming up tonight. We have 10% of the S&P 500, starting with the big dog. Amazon reports tonight. Very importantly, tomorrow they'll be here on the halftime reports. Not just Amazon earnings we're going to cover, those energy earnings. We started seeing a little bit with Royal Dutch Shell today, but we're going to get into Exxon, Chevron, Phillips 66 tomorrow. We know how important that is to the energy space. Make sure you're with us tomorrow. Big earnings numbers coming in tomorrow. But for today, let's talk Facebook. Facebook honestly came out with the juggernaut. They came out with the juggernaut. Facebook came out $3.30 a share versus the expectation of $2.36. Very healthy beat on EPS numbers. Not the percentage beat that Apple had, but in the same type of ballpark. 26.2 billion versus the expectation of 23.5. That resulted in, and those are billions in terms of revenue, that resulted in a 47.6%. Once again, slightly less than Apple, but I would put Facebook's numbers slightly less than Apple's across the board. 47.6% increase year over year. They also saw a 12% gain in total ads, and they also saw a 30% increase in the price paid per ad. So very robust, healthy numbers. The one warning that they gave is the same warning in the battle between Facebook and Apple is Apple's new privacy policy and how it impacts Facebook. That was the warning. It's the same warning that Facebook has been given for literally 3 months. The market has discounted it so far. We should discount it as well. You got to like the blowout numbers, and the price response on the overnight gap up nice 6, 7, 8%, holding its head above that water. Market's puking up a little bit on the intraday. Facebook's holding up a little bit here, Tyler. What's your read on Facebook?
I think a good template would be Google, right? Because Google had a similar look. It gapped up. It sold off a little bit yesterday, back up today. I think you got to be. I guess you got to be pleased, right? Because you do have so many other earnings stocks that we'll look at in a second, like Qualcomm, that did sell off pretty aggressively. I think what Facebook has in its favor is it gapped up so much, right? Yeah. It gapped up 6 plus 7%. I mean, look, if this thing filled the gap after opening 7% higher, then it's like, holy crap. Apple, you gap up just, 2% or whatever it was, and there's not near as big of a window to close. That probably worked to Facebook's advantage. And quite frankly, you're telling me you wouldn't want to buy a dip in this thing? Like everybody's looking for the next setup after this earnings jump.
Same thing on Google. Yeah. In fact, great catch, great call there. Facebook and Google.
We're here
both gapped up. Yeah.
Yeah, and while we're here for a sec, I mean, those two companies obviously have a component in the communication sector. Take a look at XLC here, guys. XLC, and I'm going to be eagerly anticipating conversation with the coaches tomorrow about what to do with these rankings, because two blowout numbers out of the two biggest components, and XLC is now breaking out to new highs.
Don't be shocked when it gets upgraded.
Yeah, right. Got to, right?
Yeah, you have to. It's again, market showing a little hesitation. Comms isn't.
Comms is not.
Comms is running. Let's move on to Ford here. Let's go a little bit more on the value side. Actually, let's go to Qualcomm. Let's stay there for a second. Qualcomm comes out, reports $1.90 per share versus the expectation of $1.67. Revenue came in at 7.9 versus the 7.6 billion. That resulted in a very Apple-like 52.1% year-over-year growth. You also had really big, one of the biggest components of Qualcomm is sales of phones, right? Mm-hmm. And they had very similar beats in as Apple did in that space for Qualcomm as well. Very positive numbers. Apple, Facebook doesn't provide guidance. Qualcomm affirmed their guidance. Now, technically, Tim, they raised it 2 pennies within the range, but we're going to call that they affirmed their guidance.
Yeah. So they tried the trick.
Okay. CEOs, major Fortune 500 companies, S&P 500 companies, Dow 30 components, NASDAQ 100 components, major CEOs, listen to Tackle Trading right now. Stop doing the trick. Everybody's figured it out, and it makes you seem silly.
Yeah. Tyler,
you got to figure out a new trick.
Agree. You got to come out and just beat numbers and give us.
That's not a trick. That's legitimate economic analysis. That's not what we do here in the stock market.
Tyler, technical read
here. You got a full algorithm, so I'm not done.
Oh, sure.
I kid.
I want to get his read. But because this one's interesting to me, guys, because it's a little bit different than the last two kind of gaps that we were looking at. Facebook is a gap and holding pretty much. Qualcomm is now gap and filling back into that old resistance point that you talked about, Tyler. Obviously, the stock is still up, healthy, and it had a good positive response at the cash open. But what do you do with this now with that red candle?
Well, I mean, you have to go intraday, I think, to see this. You're certainly not going to short. So the question is there a trade long here? On the daily chart, no, because you have this big honking candle in the middle of nowhere. So from a swing trading daily perspective, you have to wait for more information, like i.e. another candle. Intraday, I like that it's trying to find support here at this old resistance level. The intraday chart was bearish right off the bat. It's turning more neutral. I need to see this start to take out some intraday resistance levels. That's what it would take for me to start to turn bullish on this for the rest of the day. If we're lucky, that's what you get, right? You get this nice drop in the morning, you find support, and then you rip into the close. That would be ideal. Hey, maybe if the rest of the market finds its footing, that could happen. Until that happens, I don't think you do anything here. I think you wait and watch and see. It's got to start to show that it can move back higher before I would do anything here.
Mm-hmm. Mm-hmm. Very good. Matt, you want to do we want to do the rest of earnings roundup right now? Just kind of keep
Yes,
working through that.
let's keep going into let's go to Ford here. Gap down, sell off pretty aggressively on Ford. Little concerning from a technical perspective. Their raw numbers were actually fairly decent. They came in at 89 cents a share versus the 16 expectation. Revenue did come in at 36.1 versus expectation of 32.1. That resulted in 5.6% increase year over year. Very healthy numbers coming out of Ford from a raw numbers perspective. But the concern here, and there is concern here, they also warned of the global chip supply, but they actually put some numbers to it, and that was probably their problem. They put some numbers to it. What if all you do is come out and say, we're a little concerned, the market's a little concerned. When you come out and say it might cut our production by 50%, the market's like, well, let me hit the sell button first before you make that announcement. It's a little bit different concerning once you put that number to it. But they did warn of a 50% reduction in the second quarter based on chip supply shortages. So concern did build here on Ford. Concern from a technical perspective, especially if you start breaking some of these very important support levels. Tyler, what's your read here on Ford technically?
Look, this is what happens. This is what happens when we talked about this before. I feel like the whole electric vehicle thing, buoying just the entire auto manufacturing industry. Look, earnings is when the chickens come home to roost, right? Earnings announcements every quarter are when perception meets reality, and you have to say, look, you put up or shut up. And if we're going to lift your stock price from, what was the low last year? If we're going to lift your stock price from $4 to 14, I mean, you're talking, what is that, 300%?
Yeah.
I mean, look, they've priced in a lot of good stuff, and so you're in it. It's almost like a growth stock. Like, you're in a position where they've priced in so much good things that the slightest misstep and there's a lot of room for this to come back down. So multiples expand. You get a lot of fluff underneath the stock, and those are the stocks where you are a little nervous holding into earnings, justly so. I think this is what happens when a stodgy company like Ford gets caught up in the electric vehicle craze, and they bid the stock price a little too far, too fast, and now it backs and fills. I mean, that's the narrative. I'm not surprised. Doesn't mean it had to happen, but this is the risk when you get this type of price action ahead of an earnings announcement.
True. Greg, I do want to bring you into this one on Ford. I know you're a deep value guy. Ford's dividend payer, value-based company. What's your read here on a company like Ford? They came out with some really decent numbers. Obviously, the warning of supply side shortages and cutting the production was concerning. How concerned does that make you analyzing a company like Ford?
Yeah, it's definitely a concern. For me, auto manufacturers have always been kind of boom and bust, really. When times are good, they do very well. When times are not so good, obviously struggle. So if that supply side thing becomes an issue, obviously you're going to be producing less cars, you're going to be selling less cars, trucks, things like that. So fundamentally, that can be an issue that way. I think this was a pretty meteoric rise from the $4 up to, three times its stock price there. So being overcooked a little bit is fine too. I think we're kind of settling in. We did have that kind of, as far as I'm concerned anyway, that kind of EV, speculation, probably the last 6 months to a year. It kind of pumped up a whole bunch of stuff. Some of it was very valid, some of it not so much. And just in this space right here, Ford's dividend is not it's not as stable as I like to see them typically. They are a dividend payer, no question. But again, they kind of ride with the tide, if you will. Good is good and bad is bad. So that's problematic for a longer term investor. Really, you got to look at it technically too. it was starting to show us some lower highs even before we were getting into earnings there and lower lows, right? So we were getting that really short-term downtrend. There's no way to tell that it was going to go. So yeah, even though their numbers are good now, it's I think Tyler once said this in Trade Masters, what have you done for me lately, kind of thing. And really, if they come out and say, yeah, it could be a supply issue later, and they actually put the numbers to it as you put the data's there, then it's less of an excuse and more of like an actual concern. So that's how I see it.
Mm-hmm. Yeah, I got a little concern here, and I certainly see reversal characteristics from a technical perspective. A violation of the support level that you're looking at right now would see Ford down at $10, and even at $10, Ford is still fairly elevated versus where it was last year. And you guys are right. Ford got caught up in a little bit of the EV type news. But again, guys, when we look at EV companies, car manufacturing that are in EV, we report their numbers in millions. Ford just did 36 billion.
Yeah.
Ford, remember who you are.
Yeah.
Actually, on their dividend too as well.
They cut it last year.
Yeah, they cut it and it's gone as of right now.
And I don't think you could look at Ford and be like, listen, this is a very good, healthy buy long term until they bring that back.
No.
Take a look at Royal Dutch, right? Royal Dutch RDS/A. Royal Dutch comes out today, reports earnings. Royal Dutch comes out with 82 cents versus expectation of 79, revenue 59 billion, really healthy numbers. But what else did they do? They're starting to inch back their dividend. They're starting to bring it back. They cut it pretty substantially last year, and now they're starting to bring it back little by little by little, showing you that they're getting back to pre-pandemic. Ford, not so much, a little bit. That's a little concerning.
Yeah. Mm-hmm. But even if you look at the last 15 years of Ford, right? That's kind of the point I was making when I was going over the chart there, is their dividend is all over the place.
Yeah.
Like it's up, down, it's sideways. It's just not something steady where like you said, an investor who's looking for something longer term, it's just not.
Listen,
it's not stable enough to suit.
If that dividend hasn't increased every quarter for the last 56 years combined, Greg's out.
Yeah, pretty much.
Like you pay me my dividend or I am done.
Especially with automakers, he's got some deep opinions about.
You guys are in the industrial sector. We know what you do. You should pay your dividend.
Hey, you think it's about Ford? I own 2 Fords there, Tim.
Okay.
I got bigger opinions about GM.
So hey, I wasn't firing shots. All right.
No. Shots would have been fired on if we were analyzing GM here. Yeah. Let's move on to Caterpillar. Look at an industrial component there. Very important industrial component that has been on a metric rise over the course of the last last 6, 7, 8 months here. Caterpillar comes out 287 versus the expectation of 193. Revenue came in at 11.9 versus 11.1, and that resulted in an 11.8% year-over-year revenue increase. Raw numbers, fine. There's nothing wrong here. Not at all. Technically, we're seeing the same thing here that we saw in the rest of the market, but a little bit more aggressive here. What's your read here, Tyler, technically?
I mean, this is emblematic of what's going on today, right? They're taking profits on earnings. It's unfortunate because this had a really clean pattern coming into this announcement. In a parallel universe, this could have sparked a breakout and been just a fantastic trade. So I don't know. I mean, it's very easy in hindsight to say, yeah, I could speak with conviction in hindsight because obviously we know what happened. But I'm telling you, just conceptually, when you have a stock that's run up a lot, there's just more opportunity for them to disappoint and to not justify the price increase. I think that when you own, not that this is a terrible, it's down 3%, whatever, it's not that big of a deal, but I just think we're at that point in the market. You're 1 year removed from the pandemic. A lot of price appreciation has been baked in, and the market is kind of telling you that on a broad level that, yeah, we've kind of priced in these really good earnings and we're not willing to price in more just yet. We need some time. In the long run, it's not the worst thing in the world for stocks to take a little bit of a break. Mm-hmm. It prevents a worse correction in the future, right? Mm-hmm. And you could actually, real quick, man, I'll let you go. Yeah. You could actually draw some parallels between this and at least back in the day, monetary policy where they're trying to be preemptive when things get out of hand, right? They're trying to not allow things like I'm thinking like Greenspan and like when they would raise rates. They're trying to get in front of a bigger issue down the road, right? I feel like you want a slower, steadier climb in stock prices because it can prevent bigger, crashes down the road. So not the worst thing in the world, I think, for this to pause for a little bit. But unfortunate it didn't trigger the breakout. Just needs some time.
I certainly do agree with that technical read coming into the earnings report. I mean, this was one of those scenarios, and you can name quite a bit of stocks that were in this scenario where if you did break out, you had a really good technical scenario where you would see price appreciation. Apple's an example, Qualcomm's an example today, AMD's an example yesterday, Caterpillar's an example today as well. Some of these patterns are going to reestablish themselves, and some are going to get blown out of the water. When you take a look at Apple here, I'm still extremely interested in Apple despite the failed breakout. When you look at Caterpillar here, I'm still interested in the breakout here. Yeah. And that might change based on further evidence, right? That might change if we see a violation of the 50-day moving average. That might change if we see a violation of 215. I mean, that might change based on what happens in the future. But I still got at a minimum, you still got a neutral read on Caterpillar, which means the breakout's still legitimate. And so with the price response today, even if the market recovers, it's just going to take a little bit of time to reestablish this. But I still see a breakout potential on Caterpillar, and whether it's next week or the week after, as long as that 50-day moving average for me holds, I still think that horizontal breakout is still legitimate on Caterpillar.
I agree.
Yep. I think it's in play still. Yep.
All right, let's take a look at MGM Economy Reopening up play. And this would be another example, Tyler, of very similar to Caterpillar, very negative response on earnings, but I still think the breakout potential is still alive. It just might take a little bit of time. Raw numbers, this is MGM here. They're not going to be good numbers. We know they're not opened up 100%. Negative 68 cents on the EPS numbers. The expectation was a negative 89. So a beat officially, even though it's a negative, a beat on EPS numbers. Revenue came in line at $1.6 billion. That resulted in a 26.9% decrease in revenue year over year. It's obvious when you see these types of numbers why we're seeing a sell in MGM. I don't believe that's what is occurring here today, though. I believe that these numbers are passable numbers based on what we've seen in MGM and some of the other stocks very similar to MGM. I think MGM, like the rest of the market, getting caught up in a little bit of the selling from an intraday perspective. I still think that breakout is lined up, especially if that 50-day moving average holds. Tyler, agree or disagree?
I agree. I think it's the exact same commentary as Caterpillar.
Yeah. In fact,
percentage-wise, sorry, real quick. This is up a lot this year on a percentage basis. I mean, so it's not like it came into this getting smacked. I mean, it's priced at already good stuff. So.
Yeah, and unlike Caterpillar, that is violating some support levels, and you're clinging on that 50-day. You're still looking at a potential increasing in support right there around $40 as that 50-day moving average catches up, and and that still could line up for a really good horizontal trigger above 42.5. Keep your eye on MGM over the next week. I'm sure we'll be talking about it next week as well in the halftime report. The last earnings report that I want to discuss before I rapid fire earnings is Newmont Mining, obviously one of the most important gold mining components, and that's getting caught up in the selling behavior here as well. Now, Newmont, unlike the rest of the space, was kind of leading the space technically. It had recovered faster. When you're looking at GDX, still underneath its 200-day moving average. Newmont Mining was one of the better performers here. Obviously, this is getting destroyed here today, violating many important support levels. Their raw numbers were a miss and a miss officially, and we don't see that a lot. 74 cents against 75 expectation. So you're in the zone, but still official, and you got to be official here. A miss. Revenue miss pretty aggressively, $400 million miss, 2.9 billion in revenue versus expectation of 3.3. That would result in an 11.3% year-over-year increase. Once again, selling on the numbers makes sense, but the selling on the numbers also gets caught up in the volatility of the market today. This is being pulled down with the market. Let's keep an eye on how Newmont performs right around that 50-day moving average. Once again, understandable on the sell side of the mechanics, but I do believe it is getting caught up a little bit in the market, and it's bringing down GDX as well as you might expect. Now, GDX, though, unlike Newmont violating some support levels, I kind of like GDX in this spot. If we can get a little bit of a pivot here, once again, need a pivot. But if we can get a pivot here, Tyler, what do you think of a potential buy on GDX with a pivot?
As one who already has stuff in GDX, I am hopeful.
I'm not adding. I'm begging.
Yes,
Yeah.
I will say on Newmont. I mean, this is a perfect case study for why, no matter how nice the chart looks, because this looked great coming into earnings. It's a beautiful chart. Earnings trump technicals, and so you got to realize chart may look fantastic, but look, if they jacked up earnings and the market doesn't like it, it'll blow the pattern up very easily.
And if you look at GDX here and you look at Newmont Mining and you're saying take a look at GDX very quickly, and you're looking at GDX kissed off the 200-day moving average coming back down. Newmont's down pretty healthy in comparison. But again, where's Newmont starting at? Much above the 200-day moving average, coming back down to its sector more than anything, in my opinion.
Right. Well, and Newmont Mining has not been the easiest directional trading candidate anyways. It's been hopping in a range for a year. So
no, you cash flow Newmont. There's no doubt about that. All right. That's it for earnings in terms of the numbers perspective. I do want to get your take technically on some stocks rapid fire style, Tyler.
Yep.
Let's take a quick peek at some post-earnings potential setups. Let's go with EXR. And I'm just going to rapid fire and you kind of pick the one you want to look at, okay?
Yeah.
EXR, high base potential with an increasing trend momentum environment. PSA, same conversation. Increasing momentum in trend, high base, very consistent high base. DRE, same conversation. But again, these are all REITs. Take a look at XLRE. REITs doing the same thing. So if you like REITs, you can obviously look at XLRE. These individual components will move a little bit faster than the ETF will, though. So if you're looking at a trade, probably the stock and not the actual ETF. Out of those three REITs, which one stood out to you from a technical perspective?
The latter two, PSA or Dre. I mean, Dre's pretty clean, actually. Of the three, I'm going to go with Dre.
Yeah, I think they're all pretty clean, honestly. And it's just like, which one do you like the most? But they're all pretty clean. Keep it on your radar. The next one is utility company, Southern. Very good utility company. Southern's forming a little bit of a bullish retracement post-earnings. Don't care about the numbers. I like the technicals here and the response to earnings. Tyler, what's your technical read on Southern?
Yeah, Greg and I actually looked at utilities last night in Trade Masters. Similar look to the whole sector, and I mean, this was one of the cleaner. Not a lot of bull retracements in the market, if you think about it, coming into this week. So a good look. Sector looks good. Earnings is out of the way. A lot of things to like on this one for sure.
Love it. And then I got two left. One I'm going to give some detail on that I just forgot to do. But the last one, more of a negative response to earnings. And again, 2019, I'd be talking a pretty aggressive short, but I do want to bring it up because I do find it interesting. Teladoc post earnings. Really negative response to their earnings numbers. Their earnings numbers were garbage. Negative response to the numbers, fighting it up against some fairly important support levels right now at about 168. Don't have anything until you get into the 150, and underneath 150, it's a stone throw to 100. Tyler, what's your technical read here on Teladoc post earnings?
I have a technical read, and then I have a fundamental question. The technical read is
your fundamental question on shorting?
No, it's on the company.
Okay.
How do you what's shorting? How do you short?
Yeah, what do we do there?
I like Yes, I like it. And you say, oh, well, it's already dropped a lot, 308 to 170.
So,
yeah, but remember, I mean, this was a $80 stock, a year and a half ago. So it ain't like it can't unwind more. It's very hard to get me attracted to short trades, but I must say I'm tempted. Yes, it looks vulnerable. Here's my fundamental question. Do you think, so with the pandemic, this is like the anti-reopening play, is it not? I mean, as the economy reopens, does demand,
Teladoc, it would hurt.
So I feel like, I don't know, it just makes you wonder.
Or consumer behaviors have changed so much in the pandemic that it will actually be the future of how we do it.
Yeah, I think it's an open question.
Right? That's the question. Because there are some consumer behavior. Was that the fundamental question?
That was the question. Did the coronavirus pull forward and change consumer behavior and it has staying power, or was it a temporary thing and Teladoc's earnings are going to tank back to
I don't think we will know for years on this question for certainty. We won't know for years. But the early data does suggest that the gains these companies have made in pandemic, that most of them should stick in terms of the fundamental analysis. And consumer behaviors in the pandemic. I certainly believe consumers will do more, let's just make it easy, Zoom meetings with their doctor, right? I think you will see more of that ease and convenience for both the healthcare professionals as well as the consumers, right? Who here likes to go to the doctor unless you absolutely fundamentally have to go to the doctor?
That's
right.
Well,
on a lot of those minor things, I think these types of companies like Teladoc are actually in a good position post-pandemic, and that might actually encourage consumers to adapt to this new technology a little quicker than otherwise they would. And so I think there's an open question here that has yet to be answered, but the early data suggests that the gains and I'm not talking about the gains from a technical or price perspective. I'm talking the gains in the evolution of consumer behavior adopting technology. The early data suggests is that those gains will stick for the most part, because let's face it, consumers, once they get used to something, they don't like giving it up.
Well, and think about the news from a couple of weeks ago out of Microsoft. Microsoft made that purchase and acquisition of Nuance Technology, $16 billion, because that's what Nuance does, is digital, healthcare stuff as well. I don't necessarily, I think it's an open question in the short term. I do think long term, companies like Teladoc are in a position to capitalize on this market that's emerging.
And are they going to, from a fundamental perspective, are they going to catch up enough to justify a stock that went from 80 to 300 in less than a year? Probably not. That's why you're seeing the puking up of the gains.
Yeah.
But are they going to stabilize and be a good company and a fundamental good company moving into the future? I don't know specifically on Teladoc. It's a debt-driven company. That's a new company, in this environment. So I don't know. It's a growth-based company. We don't know if they're going to figure it out and become a value-based company at some point. They have a negative PE ratio. Their price to sales is 26.13. Fundamentally, their forward PE ratio is negative. Like there's a lot negative from a fundamental perspective on this specific company. But regarding the open question fundamentally on that, I think is more of a market question than a Teladoc question, quite frankly.
Yeah.
I do think a lot of those gains that certain companies made, I think they're going to stick longer than other people do.
Very cool. Any other earnings on the roundup there, Matt?
Knock.
The knock list.
The knock list. I had to let you. I had to let.
Dude,
I had
it's
to
a
let
gift.
the knock.
I could use it. I like it.
It's a gift that keeps on giving. There, the knock list. And if you guys don't know what the knock list is, we'll have some therapeutic sessions later, Team Tackle. But the knock, Northrop Grumman, comes out today. Robust numbers, Tim. I know you're happy over there. You're always happy when Northrop goes up. Knock goes up $6.57 versus the expectation of $5.48. Revenue 9.2 versus the $8.5 billion in expectation. Revenue increased 6.1% year over year. All I'm going to say is, in a world of reports where I see Caterpillar do 287 versus 193, Apple 140 versus 1, Facebook 330 versus 236, Ford 89 versus 16, Qualcomm 190 versus 167, McDonald's 192 versus 187. All of them getting a little bit sold. And here's old Northrop, no sell day, worse numbers.
It's an absolute no sell day. And one thing they did a legitimate upgrade of their EPS projections for the year as well.
I did not catch that, but if they did that, that would be the legitimate reason there, Tim.
Yeah. And it was interesting because they raised their revenue guidance, but they also raised their EPS guidance, just a real strong one. I'd have to get the raw numbers on it, Matt, but I was reading the report. And here's the thing that grabbed my attention for knock is look at Lockheed Martin right now, Tyler, because in the industry, in aerospace and defense, they have had a huge recovery over the last 3 months. These were beaten down stocks for a very long time. Now, Lockheed post earnings in a developing trend. I know there's tons of noise on the left of the chart, but aerospace and defense is starting to pick up here off the bottoms in the last few months. Yeah.
They are, and I'm sure we'll be talking a little bit about aerospace, but with NOC and with Lockheed, I don't feel they're great swing trading stocks.
No, investments, good investments.
Yeah, they're not great swing trading stocks. And so even with a setup like on Lockheed, typically I'm like, okay, if Lockheed's set up, let's go find a better swing trading setup that will benefit similar to what Northrop or Lockheed are doing. But
Greg, this seems like an area you might be interested in. What do you play the defense stocks longer term? You know, these are dividend payers and whatnot.
Yeah, actually, as you guys were talking, I just pulled up the dividend information for NOC there. Yeah, it's not something that's been on my radar. I do like the numbers that they post here. Their dividend's not huge, but they've got a long history of paying dividends, and they got some quality increase numbers as well. So I do like them. My only concern about this is obviously the price. You know, if you're investing in something like this, it's probably going to be for a much bigger account. You can't really argue with the numbers. They do have solid numbers. Lockheed Martin I haven't looked at in a long time, but they're doing all right as well. So
solid
actually they're doing solid. So it's definitely an area that can be a part of the portfolio as far as I'm concerned.
Fair enough. All right. I think that's our earnings roundup there. Ty, anything you want to add on those two technically, by the way? Anything
No, I just want a freaking time machine. I want to go buy a knock.
3 months ago.
You know, the problem with buying knock though, and honestly, look on the weekly chart. It's a gobble mess of neutrality. You know what I mean?
I know. I hate these stocks. Every time Tim brings the Lockheed Martin to our scouting report meeting, I'm like, what are you doing?
It's like, what do you want to do?
Let's move on already.
I like these guys. I might be on an island there. They're good.
You are on an island.
Yes.
Yeah.
Yes, I am. All right. Fair enough. A couple of quick last ones here. Then we're going to get into Greg's, segment where we're going to look at 3 different fundamental companies and play buy one, hold one, dump one. Now here in just a moment. Look at Ethereum real fast though, and then we'll Bitcoin first. Actually, give some context here. Really interesting Bitcoin relative weakness over the last couple of weeks since it broke down on that Monday morning. In fact, you even got a bearish retracement, pretty ugly chart pattern developing, but Ethereum is breaking into new highs at the same time. Separation in the crypto markets is not common in the last year, Matt. As a matter of fact, these things are very highly correlated, even on a day-by-day basis in most regards, especially Ethereum and Bitcoin being the biggest two. And they had some news around it. The European Investment Bank is going to sell bonds on the Ethereum network through Goldman Sachs, Banco Santander, and a couple of other financial firms. Pretty interesting there with Ethereum. You guys know.
So you're telling me you can buy old money with new money?
Yep, you can use.
That's what we're doing. Okay.
So, let's break that down for a second because I got some questions. So you say it one more time.
They can sell bonds.
Who is it that's selling bonds?
The European Investment Bank.
And what is the interest that European Investment Bank is paying on those bonds? 0.01% maybe?
It's less than the transaction fee using Ethereum.
So it's like, how many people are like, you know what I'd like to do with my Ethereum? I'd like to go buy some European bonds. That's what I'd like to go buy.
Absolutely nobody that trades Ethereum.
Nobody's
they're going to get zero traction on this.
Wait a second, hold on. You're telling me I can exchange my Ethereum for European bonds?
Well,
yeah, you know what? I'm not going to use the.
I know. I get it. I get it. Like,
I'm going to
okay,
take my euro and I'm going to convert it to Ethereum, and then I'm going to take Ethereum and I'm going to buy these
the
European
crypto
bonds.
world needs to realize what is news and what is not news. This is not news.
So Ty, you're not going to cash in your crypto for European bond prices yielding.
Well, it's like Matt said,
1%.
it's going to cost you more in transaction costs than the interest you're going to get for the next 20 years on these bonds. What are you doing?
All right, I get it. All right, poo-poo my Ethereum breakout.
No,
That's
it's not
fine. That's
you.
fine.
I just
All right.
I just
Oh,
want to
it
know
is
who came
him.
up with this idea.
All he wanted to do was talk Ethereum all-time high. That was it.
Yeah, Ethereum's
That's
going
it.
up and Bitcoin's going down.
Tim's
Ethereum's
like,
sorry, go ahead, Matt.
oh, I was just going to say, Tim's like, can we talk a little bit about me?
About Ethereum.
I want to follow
No,
up.
me.
I want to follow up
Like,
in the next couple of months, Tim.
Can
I
we
want
talk
you to
about
tell me.
my book?
I want you to tell me how many of those bonds actually settled in Ethereum versus
Zero.
euros or something.
Let me
Yes.
put a reminder on my Google Calendar to get you that data in 2 months, Tyler. 2 months
I'll
time,
give it to
and
you.
I will give you that data.
0.
All right, let's play the game here today, guys. Actually, one last note before we do. Energy, I'm very much looking forward to tomorrow. Matt, you did a full earnings roundup. XLE did show me some relative strength here today, and I'm anticipating Exxon and Chevron as much as anything we've seen this week. Obviously,
Well,
Amazon after the bell is, is
you, me, Tyler, Greg, Tackle Trading, and the rest of the world are anticipating those two when it comes to the energy space. So.
Yeah.
They're obviously going to be very important for tomorrow for this space, and obviously the market's been really, really good. Energy's showing some life over the course of the last week. Crude's waking up as well. Can Exxon and Chevron show some support here?
Yeah.
Well, and let's be honest. Are we going to be surprised tomorrow when it's a nothing burger like the last 15 earnings announcements and it just goes on its merry way?
Don't ruin my hope.
Even if it's a nothing burgers, we can get behind it, and you can give me a little technical breakout there because they've been picking up. They've been picking up. Yeah.
Listen, Tyler,
Tyler's just raining on everybody's parade right now.
No, he's not. Tyler's like,
you
better report, because Tyler's speaking IWM here. Energy sector has a big impact on IWM.
That's a good point. Good point.
Yeah.
All right, let's play the game here, guys. Greg, I enjoy this one a lot. It's a little different than what we do like with our Options Jedi series on Wednesday, or, like Mark's Commodity Corner and Wrap Up we're doing on Mondays, or Emily's Queen's Court. This one's a fundamental segment that we're doing on Thursdays, where Coach Greg has found 3 different companies. And, it could be dividends, it could be valuation, it could be just future prospects out of growth, whatever it is that you're interested in, Greg. You found 3 different companies. You're going to give them to us, give us some analysis and insight in behind why you like the companies, and then we get to judge. And I enjoy doing that in this game. Buy one, hold one, dump one. We got to pick one to buy, one to hold, one to get rid of. Greg, you're up.
All right, first up on the docket is ADP, automatic data processing. This thing's been around for a long time. Technically speaking, we've got a little pullback here. I believe that's on earnings that it gapped down. We got this little hammer candle right off the 50 here. So technically, I like where the pullback is to an old support zone there. Support on the line of the 50. So technically, I like the read. I also like. Someone just happened on the computer. I also like the numbers behind this thing from a fundamental standpoint. So. Dividend for this one, it's not huge. It's only 1.99%, so just right around 2%. Dividend payout ratio is only 64%, so it's got lots of room that way. It's got 45 years of consecutive dividend increases, so it's been a rock star. It's been very stable in that respect. And then finally, it started paying dividends in 1974. So literally, it's literally increased its dividend pretty much every year that it's been in existence. So it's from an inflation standpoint, it's kind of nice to get those increasing dividends year after year.
Mm-hmm.
So that's number one.
So number one here, ADP, a 2% dividend payer, pretty good payout ratios and paying dividends since its inception back in the early 70s. All right. We can work with that. What's number 2 here?
Duke Energy. So speaking of the energy space here, So Duke, same kind of scenario here, a little pullback. Now, not exactly the same as what we just looked at ADP, but a nice orderly pullback here into a support zone, confirmation today. Although earnings is coming up right shortly, I look at these things a little more longer term, and I'm less concerned about the earnings, more about the overall play itself. So like I said, I will acknowledge that earnings is coming up soon, but Duke's 3.92% dividend payout, which is kind of nice. Issue with this, and much like all energy companies, the payout ratio is 223%. For those uninitiated, that means they are taking a lot of money out of their cash reserves to pay their dividend. So that's something to keep in mind. They've got 8 years of consecutive dividend increases, and they've been paying dividends since 1926. So if we look at a longer term chart on this.
Yeah, and then I got a question.
So it's just kind of a slow grind on, I think you got this 5-year weekly here. Can we actually, go back to ADP? I wanted to show something on that there, Ty. Let's look at the 20-year weekly or the 20-year monthly even. Either one's fine. So this is what I find to be attractive with these particular stocks is it's got a decent history. So now if we can run back to Duke and look at the same thing, you're going to see that they look a little bit different, right? Not exactly the same, but still showing some strength over time. And then 1926 was their first dividend payout, 8 years of consecutive increases. So Tyler, you had a question?
Well, a point and then a question.
Okay.
I think one point that this illustrates, ADP had a dividend yield of 1.9, Duke is upwards of 4%. What you discover is you don't get paid 4% on a stock that grows by leaps and bounds, typically, right?
Correct.
Generally, the higher dividend yielding companies are choosing to reward shareholders more through cash flow, less through growth, right? ADP, you say, 1.9% dividend, not that great. But that's because it struck a better balance between giving you a lot of returns in the growth of the asset and a little bit of a kicker in the dividend. And I think just the takeaway for me is you have to look at the total return more than just pigeonholing yourself and just looking at the dividend yield or even just looking at the stock growth. So I think that's a good takeaway when you compare those long-term charts of ADP versus Duke.
Yeah, I think one of the things to think about here, and the reason I like this segment, this is why I enjoy this, is because my take on the market is different from yours and different from Tim's and different from Mark's and different from Matt's. My take on the market, even though we do the same things, we all trade, we all invest, we all do these things, we have a different view of things, right? So, depending on what your goal is for whatever portfolio you might happen to have, you might have just a growth portfolio where you're looking for a strong growth component that may make you lean one way or the other on a specific company. You might have a portfolio that's more based in cash flow income type, and that might make you lean to somewhere else. And then again, like you said, you might have that really good balance of where you look for both, right? And so then looking at the total return is an important thing. When I look at these things, I lean a little bit more to the cash flow side, which I think everybody knows, but I do that for specific reasons because, you look at an ADP who, their dividend's only 2%, 1.99, but every year for 45 years, you think about what's gone on in 45 years. We've had several market crashes, economic problems up the wazoo, and yet they just kept on clicking along, right? So, what you need to do is when you're evaluating these things and you're looking at these, whether it's from a fundamental and a technical standpoint, and hopefully all of that, right? But when you're looking at these, you have to ask yourself, okay, what is it that I'm trying to get out of this, right? And if it's that combination of growth and income, great. If it's more leaning to one side than the other, that's great too. It's all about what your expectations are, and that's why I think this is a neat little game because all the stocks that I'm bringing have different components to it, and we have different viewpoints on what we want out of our portfolios. So,
can I ask one more quick question?
Sure.
Is the Duke payout ratio of 220%, the implication is that's unsustainable. Is that something that's high because of recent developments, or is their payout ratio always just sky high and they're financing it with debt?
Yeah. So if you look at all the oil companies, this kind of took place over the last year and a half, couple of years, when oil kind of got beat up a little bit. You'll notice like Exxon's dividend payout ratio is huge. Chevron's is huge. Duke's is huge. So it just kind of seems like the energy space kind of fell in that because their earnings dropped off to near nothing, in some cases, right? And so that's where you get the bump up. So to get rid of that, just because it's got a 223% payout doesn't mean they're going to have a dividend cut tomorrow. We talked about Royal Dutch Shell, which Matt talked about. They did cut their dividend, but yet you look at an ExxonMobil, a ConocoPhillips, a Chevron, none of them have cut their dividend, i.e. Duke hasn't either, right? So with those, what it comes down to is to get rid of that high payout ratio, you either got to increase earnings, which, as we're seeing the recovery in oil, the prices are starting to go higher. That will help bring that ratio down, or you tend to cut the dividend, right? So
gotcha. Yep.
Those are the two scenarios there. But again, ideally that dividend payout ratio that's ADP had 64%, like that's sustainable long term. That could be something where they could add to the dividends, a little bit more down the road if they so chose to do so, or they can just kind of maintain it the way they're doing it. But you look at those payout ratios, and you need to dig a little bit deeper into the space in a company to make sure that, hey, can they sustain that? That's where you'd have to go and start looking at free cash flow and assets versus liabilities, things like that. Kind of do a little bit more of a fundamental deep dive into it, right? So,
love it. Yeah.
All right. Number 3 is Exelon, EXC. So you'll notice there's a bit of a theme here. A couple of pullbacks here. Well, actually, all 3 pullbacks. This one here again into known support level. Just a nice orderly pullback. Again, earnings is coming up very soon, so keep that in mind. The price tag of this $45 stock, so it's achievable for most. 3.43% dividend, a payout ratio 76%, 5 years of consecutive dividend increases, and they've been paying dividends since 1902. Now, if we look at the longer term chart, thank you, you'll see that this longer term chart is very different than the other 2 that we looked at. So these are all the things that I like to take a look at and kind of take into consideration before I decide buy one, hold one, dump one.
Okay, well, we've got 3 interesting companies, a couple in the utility space, and then ADP obviously is going to be the one standout. All right, let's start. Who wants to go first here? Tyler, maybe let's have you go first. Which one you're going to hold, which one you're going to buy, which one you're going to dump. Let's flash through them again one quick time. ADP, 2% dividend, low payout ratio, been doing it for 45 years, good, healthy technical trend, response to earnings last week, back to the 50-period moving average. Duke, Duke Energy has earnings coming up, but it's a utility company, 4% dividend, higher payout ratio in the short term, but increasing it for 8 years. And then Exelon, another utility company here, 3.4% dividend payout ratio, similar to that of ADP at 76%, has had several years of increases as well. Tyler, which one you buy, which one you hold, which one you dump?
This one's tough, man. ADP, you cannot dump. Okay, I'm using process of elimination. No way you can dump this. That long-term chart is glorious. Whether I buy it or hold it, I'm going to say I would rather buy this than Duke just because of the lower payout ratio. So I'm going to buy ADP. I'm going to hold Duke, hope it grows its way out of the payout ratio drama. And then I'm going to dump Exelon just because when I looked at that 20-year chart, got a little indigestion by looking at 2008.
Okay. Matt?
Yeah, Duke's a dump for me on this one. I think they're simply better energy companies. Southern, we talked about their earnings numbers today. Southern's raw numbers from a fundamental perspective has better valuation, similar dividend. WEC, Edison, similar. So Duke's a dump for me, more from a valuation concern. Outside of that, Duke's just performing with the sector. ADP is probably the buy out of these. Tyler's right. That long-term chart is just intact and glorious. I mean, if you're looking for growth in this area, you got some options, but ADP is pretty decent there. So ADP is probably the buy. It would be the hold. Exelon will be the hold in this game, but Exelon and Duke, I would dump both of them for Southern.
Mm-hmm. Mm-hmm. All right. Well, that's where the debate is. ADP is a buy for me. That has the growth potential, the balance. I love the conversation, the questioning you had earlier for Greg Ty, because when companies try to find that balance between growth and dividend, you are rewarding investors in two different ways there. And ADP has had a really healthy chart for the better part of a decade now. Exelon and Duke. I mean, I don't really concern myself about the chart too much. I'm more looking at, okay, payout ratio. If I'm going to play utility, which one do I want the dividend on? And it's a coin flip for me. I do think I would rather just do XLU or like Southern, like Matt was talking about within utilities. But if I got to hold one, I will hold. I'll hold Duke. It's got a little bit better long-term chart. I'm with Tyler on that one. I have concerns about both of them, but I would dump Exelon. And Greg, what would you have done?
Yeah, so great analysis on all of it. You cannot argue with ADP. They're juggernauts. I've actually been looking to, just looking for spots to buy it, to be honest with you. So ADP for me is the buy. The hold for me would be Duke. Again, I think there's some opportunity there for a run up. And Exelon, unfortunately, you're just getting the dividend out of it. Duke, again, I'm less concerned about the dividend payout ratio with that one, just because of pretty much that whole space is in that kind of same scenario, with the exception of the oil companies that have already, or the energy companies that have already cut their dividends. So less concerned about that. So ADP's the buy, Duke's the hold, and Exelon, just because of the lack of growth over, that long-term chart we looked at. I think that would be the one that I would dump as well. So.
Very good. Thank you, Greg. As always, 3 stocks for buy, hold, and dump one. Obviously out there, Team Tackle. Would love to have you play along as well. Which one would you buy? Which one would you hold? Which one would you dump? Chat's been going lively and on fire here today, so let us know. I see Mark has popped in, end of the show to help us kind of promote whatever we're doing over here at Tackle Trading. Also, Mark, you got to sit in on that segment. Obviously, longer term analysis, fundamental analysis, something that's always going to trigger with you. But how are you doing today, sir?
I'm doing great, actually. No, I'm doing great. I spoke. My cat just was startled by a human voice this morning. No, I'm doing great, though. I got Cash Flow Club tonight. Gino Poor. I always love Gino's mind. It is a unique mind. And it's always, when he gets going on cash flow, man, it can go a lot of different directions, and there's a lot of different strategies he uses. I love that segment, too. I'm a little light on dividend things, and so I love buy. What do we call it? Buy, dump, hold?
Buy, hold, dump one.
Buy, hold, dump. I like it. I love ideas.
Sure.
And that's what Tackle Trading does so well.
Let's go back on the broad markets for a second, start getting final thoughts. Fun, lively show here today. Appreciate all the coaches and your insight and your analysis. Let's start with our guest here. Greg, you first. What final thoughts on the market here today?
Yeah, so I don't think anything's really changed. It's kind of just sitting there. It feels a bit overextended to me, but that doesn't mean anything. The way I look at this market is it's going up until it tells me it's not. The way it tells me it's not is it starts breaking some levels. It's not showing any of that right now. I don't get too concerned about a doji candle. I like to have confirmation whether it's going up, down, or sideways. So really, we're just kind of sliding sideways, which is good, right? So if we do tend to slide sideways, for a little while, we get those moving averages catch up. The only thing is we look at this run here. It's run up a bit. We did this last August and then had a bit of a turn there. So a little bit of relief. We're getting that relief from the sideways action, but sometimes it's a little bit better to get a little pullback too. So just caution there. We talked about some levels intraday. You just have to look at those levels and play them accordingly. That's how I've always done it. And I think that's the only way to do it, to be honest with you.
Support is holding for now, Tyler. What are your final thoughts there on that intraday? Is an interesting.
My final thought is that buy one, hold one, dump one is the new rally caps. You're welcome, fellow traders. All right. We brought Greg in, and we single-handedly rescued the market from that morning sell-off.
Yeah. I'm
back
sure
to
the
your-
value analysis really helped the growth of the market today. Yes.
Oh, dude,
Yes.
it was.
I'm pretty sure it was that Ethereum bond conversation.
It might have been the Ethereum bond conversation. That is true. Tim, looking at the market today, the concern is obviously based on everything we've seen in the last 24 hours, the expectation would have been a little bit more price appreciation. Sometimes it just takes a little bit of time, and the intraday analysis is going to be the story over the next 24 hours as we get, through the next day and Amazon's report and the economic reports that are coming out tomorrow. But the concern is not big right now. The concern is, okay, why are we doging on a day we should be up 2%? It's a little bit of concern. But it's not confirmed until we start seeing some violations of patterns yet. And as of right now, if you add Mark's girlfriend to the chart here, that little 9 EMA, that 9 EMA had a little kiss on the cheek today. Did. Kissed on the cheek, formed intraday support, got gobbled up. We'll see if this positive data takes a little bit of time to really kind of price into the market. And sometimes when you have this much news, it takes a little bit of time to just process all of it a little bit. Right now, we're holding support intraday. We're holding those levels. It's going to be a fascinating next 24 hours.
Matt, did you see what I just did?
I did.
You got me so flustered. I deleted Mark's girlfriend.
He deleted the charts that he called Mark's girlfriend.
I did not catch that. I did not know you killed Mark's girlfriend.
Hey, when you redo it, Tyler, just label it Janet. All right, because the girlfriend's been named Janet. So
is this a Janet Yellen reference, or is this a real Janet?
We don't need to have this conversation.
Oh, if you guys want to go for 35 more minutes, I could talk about Janet Yellen if you want.
Yeah,
no, we're good.
But add the 9 EMA. We're not leaving until you add the 9 EMA there. There we go. It doesn't matter. It'll figure it out.
Flustered.
Delete Mark's
pink is your color, right?
No, pink is everybody's color. That's not pink. You're not even in the pink zone.
Don't knock it off. That is pink.
That's more red. That is absolutely red. We're going to debate this.
Looks pretty
Pink's
pink.
left.
It's fuchsia.
This is fascinating.
This is amazing to me.
Oh, wait, no,
keep
I was
this
thinking
live.
purple. I was thinking purple. Okay.
We got there.
I don't know.
That was pink.
There you go.
Tyler, I'm assuming you don't have a lot of pink
They-
shirts, my friend.
I don't know. I don't have anything pink. Geez, I thought
You
I was going
should.
to rescue
You're missing
myself there.
out.
This is getting worse as I go.
I was wondering if you're going to apply it. Now zoom in there real quick.
I got to save this bad boy too.
You
Yeah,
can
go ahead. Make your point though. Now it's there.
Zoom in there. That 9 EMA caught up to it today. Kissed off it. Still playing defense, and that's still very good for the market.
Yes.
Yeah, holding up near the high. All right, guys, that's our show here for a Thursday. I appreciate everybody out there, your participation, showing up. We love doing this for our community here, guys. Hashtag Team Tackle is our official hashtag here at Tackle Trading. Make sure that you pop it in each and every day, starting the conversation with that hashtag. If you're new to our channel, subscribe, click the bell, and come back and join us. And if you're new to Tackle Trading and not yet a pro member, there's always a 15-day trial link in the comments of every one of our YouTube videos, or you can visit the website. It's right there in the store, right there on the front page as well. Come and join us on the back end, join our traders lounges, start our courses, get some education from a community of traders here. Great job, coaches. Today we are out. We will see